How did anyone predict the 2000 financial crisis? Imagine watching a house of cards slowly wobble, knowing it might fall at any moment. That's how some experts saw the economy before the 2008 crash. While most didn't see it coming, a few did. They spotted warning signs that things were not as stable as they seemed. These signs included rapid credit growth, risky financial practices, and big imbalances in the housing market. During the years leading up to the crisis, banks and lenders were giving out loans more easily than ever. Mortgage lending standards weakened, creating a bubble in real estate prices. These loans were bundled into complex financial products called mortgage-backed securities and derivatives. These products hid the true level of risk, making it hard to see how fragile the system was. Some economists noticed that credit was growing much faster than the economy itself. When credit outpaces economic growth, it often signals trouble ahead. Others pointed out that financial institutions were borrowing heavily to invest, which is called high leverage. This made the entire system more vulnerable to shocks. Regulators also failed to keep pace with new financial products, which became more complicated and harder to understand. This lack of oversight allowed risky practices to flourish. One well-known critic was Peter Schiff, who warned as early as 2006 that the economy was like a house of cards. He said falling real estate prices and a credit crunch could cause a big crash. He criticized policies like low interest rates and high government spending, which he believed masked the real problems. Researchers also looked at early warning signals like rapid increases in credit relative to gross domestic product, high inflation, and large trade deficits. When these indicators appear together, they can suggest an impending crisis. The actual trigger came in 2007, when banks started losing money on subprime mortgage securities. This caused a run on the shadow banking system, which relied on short-term funding that could disappear quickly. These events revealed weaknesses in both private banks and government oversight. In practical terms, those who predicted the crisis advised caution about rapid credit expansion. They warned that when credit grows faster than the economy, a downturn often follows. Monitoring these signs can help policymakers and investors spot bubbles before they burst. In the end, the few who saw the warning signs were right. They recognized that excessive borrowing, risky financial practices, and regulatory gaps could lead to a major economic disruption. Their early warnings reminded us how important it is to watch for signs of instability in the financial system.